well, other elected officials could also play a big role in this, meaning senators and the House, as they're clashing with the debt ceiling. An impasse is currently the status quo, but we have played this game before where both sides hold out. How do you see the debt ceiling playing out?
So general consensus seems to be that they're going to come down to the wire and then make a deal. I think the risk is that the market might be underestimating the probability of going days or a week over that line and having some sort of technical default for a period of time. For me, because I'm not a political strategist, I don't have a lot of insight in the probability of those outcomes, but what I am focused on is what happens after the debt ceiling. I think there's so much focus on the debt ceiling itself, there's not enough focus on what happens after the debt ceiling. And so for the past 6+ months, the story's been Fed quantitative tightening, raising rates, but something that's not been covered enough is that the Treasury has actually been offsetting a lot of the Fed's tightening. The Treasury has been emptying their cash account into the financial system. And partly that was because they had too much cash in their account to begin with compared to their target. But then starting in January, the debt ceiling actually made them lower their cash account. So when they were in a situation where they were no longer able to issue new debt, one of the ways that they deal with that is they say, okay, we have an existing cash balance that we can begin drawing down. And so their target is to have about $500 billion in that account at all times. In their preferred environment, that's what they would do. But in recent months and weeks, they've drawn that down to under 100 billion, which is way below their target because they still have bills to pay, but they're not able to issue debt. And ironically, while that's happening, while that cash is draining out of this Treasury void and back into the financial system, it's actually offsetting a lot of the QT that's been happening.
So they're nullifying each other. They're canceling each other out.
Exactly. They're nullifying each other. But then the question becomes, when they actually solve the debt ceiling, if the Fed wants to keep doing quantitative tightening and the Treasury is no longer emptying its cash account because it'll be practically empty, and then if they want to refill their cash account back up to their target, then it's like a double negative for liquidity. Because they're actually joining the Fed in pulling liquidity out of the market. And I think that's where you could get breakage. If things surprise to the upside in terms of how bad they get, I think it would be because the Treasury does not manage that refilling process well. If they, for example, if they shorten the average duration of the treasuries that they want to issue, then they can probably handle it more smoothly because they can probably get money out of the reverse repo market and into their T-bills. If they try to refill the Treasury account quickly, or they do it too much with longer duration bonds, they're more likely to cause yet another liquidity crisis because they risk pulling that liquidity out of the banks that are already very liquidity constrained.
Given you're not advising the Treasury, and perhaps you should be, what do you think the likely scenario is then?
I think they're likely to try to refill it more slowly than they otherwise.
So they will hopefully.
But I don't have political insight to what extent Secretary Yellen is monitoring this liquidity situation. It's not something she brings up regularly. And so there actually are a number of traders that are concerned that maybe they don't fully get the liquidity implications they can have for the market if they try to refill that too quickly.
You said breakage could happen if the Fed tightens and the Treasury starts to refill, as you say, at the same time. Expand on the breakage idea.
I think the closest example would be September of last year. So for much of 2022, net liquidity was headed down because Fed was doing quantitative tightening. The Treasury was not offsetting it for most of the year. And you started to get very liquid U.S. Treasury markets. So you had, the move index was super high. Auctions were kind of sloppy, Treasury auctions. And then it was even worse in the UK. You actually had the gilt market basically break and require unexpected QE temporarily by the Bank of England to stabilize it. But all the attention was on the gilt market, and there wasn't enough attention on the fact that the U.S. Treasury market was kind of only a step behind. It was very fragile in that moment. But when the Treasury started drawing down its cash balance and offsetting that, it actually reprieved a lot of it. So by breakage, I mean almost like a replication of those conditions where you would probably see a higher move index. You'd probably see weaker Treasury auctions. You probably would see a stronger dollar because the dollar generally benefits from a weaker liquidity situation until you had some sort of dysfunction show up in the Treasury market or in adjacent markets or another round of bank failures. And then you'd probably have to have some sort of change either with the Treasury, how they're handling their cash refilling, or with the Fed, they might have to end quantitative tightening, or they might have to take other sort of measures to prevent that breakage.
So in that scenario, or the likelihood of these scenarios playing out, what is the best way to navigate it from a portfolio investment perspective?
So I'm primarily sticking to a diversified approach. I call it the 3-pillar portfolio, which is basically one pillar is cash equivalents, money markets, T-bills, things like that. Another pillar would be equities, just long-term compounding equities, being able to absorb that volatility. And then the third would be commodities and hard monies. It's more of the inflation component. From a more tactical standpoint, if someone's trying to trade around this, which is more challenging, I think the kind of prevention there is to somewhat be defensive until you see signs that maybe the liquidity profile is improving. So if you start to see that the Federal Reserve is going to end their quantitative tightening, or you see some sort of realization that they're starting to cause problems in the treasury market and they reverse course, that'd probably be a buying opportunity. But I think until you see signs of liquidity kind of stabilizing after this debt ceiling, I think it's worth being defensive.
Okay. And the best way to be defensive?
Probably focusing on money markets, because you have cash equivalents without much counterparty risk, and your biggest counterparty is the Fed rather than the Treasury that might ironically temporarily default on you. So I think money markets are pretty attractive. And I think in general, just diversification. So having defensive equities, I've been pointing out things like energy pipelines, for example. If someone doesn't want the volatility of the producers, I think a number of the highest quality pipelines are actually pretty attractive in this environment. They've kind of washed out a lot of their leverage. Their valuations are cheaper. So I think more income-focused kind of recession-resistant businesses along with money market exposure is a good way to kind of be defensive until you see signs of a liquidity change.